Happy Monday out there, Team 42. It's your skipper here, Darius Delta, present our macro minute for Monday, July 7th, 2025. Hope everyone had a wonderful holiday weekend. So, as always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk or to get on the right side of market risk to the extent you have been following Kiss and Dr. Mo, you need to be a client of 42 Macro. So, today's key macro question is: are investors too complacent about Wednesday's reciprocal tariff deadline? Our answer: no. Akin to our signaling regarding congressional brinksmanship last week, investors should continue to treat trade policy uncertainty as one of several scarecrows to be faded by every investor with a time horizon that extends past this summer. For our February 5th leadoff morning note, all told, we do not believe tariffs are a mere negotiating tactic. Investors should, however, anticipate more successful negotiations and for some of those negotiations to end in more weak trade deals that achieve very little in support of reshoring manufacturing jobs or reducing U.S. trade deficits. President Trump is unlikely to pass up any opportunity to claim victory, however shallow and largely symbolic, such as the USMCA and the Phase 1 China trade deal, which he negotiated during his first term. For our April 12th Around the Horn presentation, in our view, this past week represents the most transformational week in asset markets since the Lehman Brothers bankruptcy catalyzed nearly 2 decades of fiscal monetary policy largesse. Geopolitically driven stress in the Treasury market is accelerating the transition from U.S. exceptionalism to the U.S. being an emerging market in capital flight risk terms. President Trump may be operating under the assumption that the U.S. is too big to fail, and foreign creditors may check him on that. Markets thought Lehman was too big to fail, too. This transition has several profound implications for asset markets. Number one, the rest of the world has much more negotiating leverage than anyone in the Trump administration is willing to admit publicly, increasing the probability that reciprocal tariff rates are broadly lowered in deals that President Trump will celebrate as wins, but are likely to be less effective than the Phase 1 China trade deal and USMCA that he negotiated during his first term. We wouldn't be here today if the art of the deal actually worked back then. Elsewhere, Tesla is down 7% today amid fears of President Trump backlash against Elon Musk, after Elon Musk launched a new political party, the America Party. The announcement followed President Trump's signing of the One Big Ugly Bill into law, which ends the Biden-era $7,500 electric vehicle tax credit this year. Musk vowed to form the America Party and boost political donations if the One Big Ugly Bill passed, blasting it for funding, quote, industries of the past while severely damaging industries of the future and raising the federal debt limit by $5 trillion. If you want to understand one key reason why the U.S.'s increasingly K-shaped economy will contribute to durable Fed yield curve control by the next general election, reread Musk's quote and replace the word industries with rich people. So let me do that for you right now. Rich people, let me read the sentence. Musk had vowed to form the American Party and boost political donations if the One Big Ugly Bill passed, blasting it for funding, quote, or Darius quote, rich people of the past while severely damaging rich people of the future. So again, this is something we continue to highlight in our research, specifically just the trillions of dollars, at the amount of money that the government is pumping into the pockets of rich people and how that is contributing to crippling wealth and income inequality, the crowding out of low-income, consumers and businesses on the bottom part of the K, and ultimately also contributing to inflation that would otherwise be lower than it currently is. And so the risk that we see continue to see political volatility, which is a hallmark of every fourth turning, the risk that we continue to see political volatility because we continue to copy and paste this K-shaped economy and make it bigger and drag it further into the future, the likelihood that we see political volatility in a way that perhaps tests socialism out as a national policy in 2028, November 2028, is a big risk to the bond market, and ultimately one of the reasons, several reasons why we think we're headed for durable Fed yield curve control, which is why our completely systematic KISS portfolio construction process features stocks, gold, Bitcoin, and no bonds. So transitioning to our 42 macro dashboard, as always, we'll wrap up with a question from our community. This one's titled KISS Signal Changes. It says, when the KISS signals indicate sale of current positions for rebalancing, how should the individual investor factor in tax consequences for sales for the use of the KISS signal strategy? So excellent question. This is something we've talked about ad nauseum here. So if you want to catch up, if you're a client of 42 Macro, you want to catch up, just type in tax into the AI-powered search function. You'll be able to find a bunch of posts that myself and other clients have had discussing different tax things. But the number one thing I'll say starting with this is, we can't build a strategy that satisfies everybody's tax consequences. We have thousands of clients in 80 something countries around the world. Every single one of those clients has a unique tax situation. Some are investing in tax advantaged accounts, some are investing in taxable brokerage accounts, some are doing this, some are doing that. I'm doing this, you might be doing that. Again, we cannot create an investment strategy that satisfies everybody's specific tax consequences, because the reality is we all have our own individual tax consequences that we as individuals are responsible for addressing. So that's number one. Number two is the obvious solution, and the solution that the thoughtful people everyone in our client base is very thoughtful, so I apologize for even going there. But the solution that the most thoughtful investors that are employing our KISS strategy have figured out is to just execute it in a tax advantaged account. Like if you have the choice to execute KISS in a taxable brokerage account or a tax advantaged account where you have tax deferral, then why wouldn't you just execute it in a tax advantaged account? Obviously, in America, again, thousands of clients in 80 plus countries around the world, not everyone has 401ks and IRAs in country A, country B, country C, country D. So again, I'm speaking specifically for Americans. Obviously, if you're executing KISS in the 401k or IRA, you're going to have tax advantages that allow you to execute this and any other risk management overlay to your benefit from a tax perspective. But even if you are executing KISS in a taxable brokerage account, it's still way better than not executing KISS in a taxable brokerage account. The alternative to not employing institutional grade risk management overlays to your portfolio is having your portfolio crash. Would you rather have your portfolio crash and not pay taxes? Or would you rather book gains ahead of the crash because you have institutional grade risk management overlays like the ones we feature in our KISS systematic portfolio construction process? Would you rather book the gains ahead of the crash and buy the dip so that you can eliminate the volatility drag from your portfolio, or a large degree of it, which helps you compress the amount of time it takes you to grow your account to a desirable level so that you can retire on time and comfortably? That's what institutional grade risk management overlays do in terms of adding volatility, targeting, and dynamic position sizing to your account. If you choose to ignore those things, i.e. you don't want KISS, you want to keep doing what you've been doing, which is, hey, every 2 to 3 years, by the way, that's now reality. Go back to 2018, we've had 3 market crashes. So no, we've had 4 market crashes since Q4 2018. Q4 2018, Q1 of 2020, obviously the first 3 quarters of 2022, and then we had another one in Q1 of 2025. So we've had 4 market crashes since Q4 of 2018. 4. And every single one of those times, if you have been working for 20, 30, 40, years to accumulate the amount of money that's in your account that you've been saving for retirement or saving to give your children, leave them a gift after you go to the great beyond. If you've been working your whole life to save that money, I got to imagine it's not going to feel very good to be down 20% from your high watermark at any given time. And so this is what KISS avoids. It adds risk management to investors in a way that allows them to continue participating in bull markets as they get closer and closer to retirement. Most pie chart asset allocations and target date funds, they want you to get out of stocks, gold, and Bitcoin as you get closer to retirement, and they want to give you bonds, which very clearly we're in a structural bond bear market. I mean, I don't know how you can argue that we're not at this point. We're in a structural bond bear market, and Wall Street wants to stuff you into a bunch of bonds as you get older. In my opinion, that may be smart. At least it was smart when we were in a 40-year bond bull market. But in my opinion, I think the number one asset class in the world that has the maximum amount of risk over the medium to long term is the treasury bond market. So why in the world would you want to increasingly allocate your life savings to an asset, to what I could consider to be, based on our research, which I think is some of the best in the world, to a melting ice cube of an asset class? To me, I think it's a much smarter choice is to be long the asset classes that are going to go up at exponential rates, while also having the peace of mind and the confidence to remain invested, because the risk management overlays that we feature in KISS are going to help you, raise cash and get to the sidelines either early in or right before a big decline or a big crash in the markets, that again allow you to eliminate all that stress and baggage from your portfolio and life. By the way, can't imagine being married to somebody whose portfolio is down 25% from the highs. That can't seem very pleasant, especially if you've been working for 20, 30 years to accumulate that life savings. I can imagine that might end up in divorce. So again, there's so many benefits to our KISS strategy. I'm going to stop rambling, but the number one thing I will say is, if you're concerned about taxes, And the average right now, KISS averages 2 trades per month. If you're concerned about taxes on those 2 trades per month, just know that your choice to hodl and not pay taxes, hodl and not pay taxes will result in your portfolio being down 20 to 30% from the highs every 2 to 3 years. That sounds crazy to me if that's your choice. I'd rather pay taxes to avoid that. But again, you also don't have to execute KISS in a taxable brokerage account. The most thoughtful among our clients are the ones executing it in tax advantage accounts. And so there's so many ways to win with KISS. If you can't win with KISS, it's on you, not us, because there are thousands of investors around the world that are winning and high-fiving each other religiously as a function of what we built here. We're really grateful for that. So appreciate you. We'll catch you back here tomorrow. Cheers.